Hello, everybody. This is Harjinder, and in this video, I'm going to go over problem 5-18. Um, the problem presents information about a company called Rafskin that uses a job order costing system, and we are given the beginning of the year inventory balances for raw materials, work in process, and finished goods. We're also told that the company applies overhead costs to jobs on the basis of machine hours, and that for the current year, the company had estimated it'll work 36,000 machine hours and incur $153,000 in manufacturing overhead costs. And we're told that the following transactions were recorded for the year. These transactions are listed A through J. And what we're asked to do is, number one, prepare journal entries to record the transactions, make T accounts for inventories, manufacturing overhead, and cost of goods sold, post relevant data from journal entries to these T accounts, calculate the ending balance in each account, and then determine if the manufacturing overhead is underapplied or overapplied for the year, prepare a journal entry to properly dispose of any balance in the manufacturing overhead, and then to finally make an income statement for the year. So this question is fairly similar to something that you could encounter on your midterm. The midterm question may not contain a couple more pieces of information as have been given in the problem. And so that question may be a little bit more involved than this one, but this is a good start. So first things first, what we should be doing is to calculate. So step one is always about calculating the predetermined manufacturing overhead rate. So the predetermined manufacturing overhead rate is basically the estimated manufacturing overhead divided by the budgeted. This company charges manufacturing overhead on the basis of machine hours, so estimated or budgeted machine hours. So in this problem, the estimated manufacturing overhead for the year was 153,000, and the budgeted machine hours are 36,000. So $153,000 divided by 36,000 machine hours, 153,000 divided by 36,000, we get $4.25 per machine hour as the predetermined manufacturing overhead rate. Now, in this step, we should also calculate the manufacturing overhead applied. So total manufacturing overhead applied during the year is equal to the manufacturing overhead rate multiplied by the actual number of machine hours during the year. So we know that the manufacturing overhead rate was $4.25. We want to multiply that by the actual machine hours during the year. So if we go back to the information, skim read, we find that the company recorded, so H says manufacturing overhead cost was applied to production. The company recorded 40,000 machine hours for the year. So 40,000 actual machine hours, $4.25 times 40,000 machine hours, we get manufacturing overhead charge to various jobs, $170,000. So you want to do this calculation first. This question is asking for journal entries to record transactions. Your typical midterm exam question will not ask for the journal entries, but rather you'll be expected to directly post these transactions into the T accounts. Because it's still early days, I don't mind going through the journal entries one more time. We've been through the journal entries in the lecture video. So journal entries, this is part one, the journal entries. So for information A, raw materials were purchased on account $200,000. You want to debit raw materials inventory and credit accounts payable $200,000. Next, for B, we've got raw materials for requisition for use in production, a total of $190,000, of which 80% were direct and 20% were indirect. So you want to debit work in process inventory for the direct materials. You want to debit manufacturing overhead for the indirect materials, and you want to credit raw materials inventory for the total amount of raw materials requisition. That's 190,000. And out of the 190,000, 80% or 152,000 was for direct materials, and the rest, 38,000, was for indirect materials, which we know are part of manufacturing overhead. Then C told us that the following costs were incurred for employee services: direct labor, 160,000, indirect labor, 27,000, sales commissions, 36,000, administrative salaries, $80,000. Now we know that direct labor will be added to work in process. So debit work in process, 160,000. For the indirect labor cost of $27,000, you want to debit manufacturing overhead. And then thirdly, for the sales commissions and for administrative salaries, you could debit. So for purposes of the midterm exam question, you are asked to record these into a T account called operating expenses. So you could choose to do that, or if you want to go as per the textbook solution, you will want to debit sales commissions and administrative salaries. So sales commissions, 36,000, and administrative salaries, 80,000. The total costs were $303,000, for which we credit salaries and wages payable. D talks about heat, power, and water costs were incurred in the factory, $42,000. That's utilities costs for the factory. These are essentially factory-related costs, so you would debit manufacturing overhead, total $42,000, and credit accounts payable. And E, prepaid insurance expired during the year, $10,000. 90% relates to factory operations, 10% relates to selling and administrative activities. So the 90% of the prepaid insurance that relates to the factory operations, you want to debit manufacturing overhead. And for the remainder, you will credit insurance expense. And debit insurance expense, and the total amount is credited to prepaid insurance, which is $10,000. So 90% of 10,000, or $9,000, is for manufacturing overhead, and the rest is insurance expense. Next, we have advertising costs for incurred $50,000. So debit advertising expense and credit accounts payable, 50,000. Okay, G, depreciation was recorded for the year, $60,000. 85% of it relates to factory operations. So debit manufacturing overhead for the portion that relates to factory, and the rest is debited to depreciation expense. And we want to credit accumulated depreciation. The total amount of accumulated depreciation is 60,000. 85% of it for the factory, the rest, $9,000 is expense. 8, manufacturing overhead costs was applied to production. So we calculated what the manufacturing overhead cost that was applied was for 40,000 actual machine hours at $4.25 per machine hour. We calculated 170,000 as the applied manufacturing overhead. The journal entry for the applied manufacturing overhead is you want to debit work in process and credit manufacturing overhead, $170,000. Step I, goods that cost $480,000 to manufacture according to their job order cost sheets were transferred to the finished goods warehouse. So you want to debit finished goods inventory and credit work in process, 480,000. And then finally, J, sales for the year total 700,000 and we're all on account. So debit accounts receivable and credit sales revenue, 700,000. And the total cost to manufacture these goods according to their job cost sheets was $475,000. So debit cost of goods sold and credit finished goods inventory, $475,000. So these would have been the journal entries to record the transactions. Next up, we got to make the T accounts. So we've been asked to prepare T accounts. So that's part 2, or step 2, the T accounts. And we're going to be making T accounts for raw materials, so we're going to be making T accounts for raw materials. We'll be making a T account for work in process, and we're going to make T account for finished goods inventory, so raw materials, work in process, finished goods, manufacturing overhead, cost of goods sold, and we can make a T account for sales, And finally, we can also make a T account for operating expenses. So the inventory accounts, the raw materials, work in process, and finished goods, they're all inventory accounts. And inventory accounts will all have balances. So beginning balance for raw materials, for work in process, and for finished goods. The numbers were given. 16,000 was the beginning inventory for raw materials. 10,000 was the beginning balance for work in process. 30,000 for finished goods. So inventory is an asset. So 16,000, 10,000, and 30,000. Okay. Next up, we would post the journal entries. So raw materials were purchased on account. So purchase of raw materials, you debit raw materials inventory. So purchases, debit the raw materials for $200,000. Then raw materials were used. So the raw materials that were used, a portion was regarded as direct materials and the other portion as indirect materials. So direct materials, the cost was 152,000, and that goes to the debit of work in process inventory. So you want to debit work in process inventory for the direct material cost and credit raw materials. The indirect material costs, we credit raw materials and debit the manufacturing overhead account. So debit raw material, debit the manufacturing overhead, and you want to credit our friend the raw materials for that $38,000 as well. Okay. Now notice the total that we credited raw materials is $190,000. Of this amount, 152,000 goes to work in process and 38,000 goes to manufacturing overhead. And since there's no other transaction in raw materials, we can actually calculate an ending balance. So for the ending balance, we want to add up the debits and subtract the credits. You get a ending balance of raw materials, $26,000. For work in process, it'll always have three components added to it: direct materials, direct labor, and the applied manufacturing overhead. So direct material cost was $160,000. The indirect labor cost that is added to manufacturing overhead was 27,000. And then under operating expenses, we have sales commissions and admin salaries of 36,000 and $80,000 respectively. Next up, we have the incurrence of manufacturing overhead for utilities costs, $42,000. So debit manufacturing overhead, $42,000, and that's basically for the utilities. And then for the depreciation, we want to debit manufacturing overhead for $9,000. And then operating expenses, sorry, that's depreciation. $1,000. Hang on, my bad. That would have been insurance expense. So not depreciation, it's insurance. Okay, next up, we have advertising expense, $50,000. So that goes into operating expenses. And then we have the depreciation. The total depreciation is 60,000, of which 15,000 goes into manufacturing overhead. And the rest into operating expenses. Right, next up, I have the manufacturing overhead being applied. Debit work in process for 170,000 and credit manufacturing overhead for the 170,000. So debit work in process, 170,000, and credit manufacturing overhead. So this is the applied MOH, $170,000. Then for the finished goods that were transferred out from the factory, debit finished goods inventory, 480,000. So that's the cost of goods manufactured, $480,000. And credit work in process for that $480,000. For sales revenue, you want to credit sales revenue for $700,000. And then finally, for the cost of goods sold, credit the finished goods inventory, 475,000, and you want to debit cost of goods sold, $475,000. So we have completed posting all of these T accounts, all of these transactions rather, to these T accounts. Now we want to take balances for work in process. If we add up the debits and subtract the credit, 480,000, we get an ending balance for work in process, $12,000. Likewise, if we add up the debits in the finished goods account and subtract the credit, we get $35,000, which is the ending balance for finished goods. For manufacturing overhead, on the credit side, we have a single line, 170,000. The debit total, if you just select all the cells on the debit side, the debit total is $167,000. So because the credit side is heavier, we are going to have a credit balance or manufacturing overhead. A credit balance means the applied manufacturing overhead was over applied, right? We have an over applied manufacturing overhead. Now, the over applied manufacturing overhead, according to IAS 2, must be prorated, right? It must be prorated to cost of goods sold, finished goods, and work in process. All right, so that's step 3. We can do it here. Step 3, close over applied manufacturing overhead. So the journal entry here will need us to debit the manufacturing overhead account for $3,000. So we want to debit manufacturing overhead for $3,000. And we will credit work in process inventory, finished goods inventory, and cost of goods sold. So this $3,000 of the overapplied manufacturing overhead will be allocated amongst work in process, finished goods, and cost of goods sold. How much should be allocated will call for a calculation. Okay, so calculation for allocating overapplied manufacturing overhead. We want to take the ending work in process, the ending finished goods inventory, and from cost of goods sold, we want to subtract the beginning work in process and the beginning finished goods inventory. So ending work in process, $12,000. Ending finished goods is $35,000. Cost of goods sold is $475,000. Okay, let me just, because they asked us to calculate ending balances, let's just do that. So for cost of goods sold, before any kind of adjustment is made, its balance would be $475,000. For sales, $700,000. And for the operating expenses, it's just going to be the total, $176,000. So for cost of goods sold, $475,000, we want to minus from that, take away the beginning work in process, which was $10,000, and the beginning finished goods inventory, which was $30,000. So taking those numbers away, we get $435,000 remaining. Add these up, we get a total of $482,000. So for us, we have to allocate $3,000 in total, right? $3,000 is the total manufacturing overhead. So we have to do this proportionately. So how do we do it? We take 12,000, which is the ending work in process, out of 482,000. 12,000 divided by the total of the ending WIP, ending finished goods, and the cost of goods sold adjusted for the beginning WIP and finished goods balances. So 12,000 divided by 482,000 multiplied by 3,000. You get $75. For the ending finished goods, 35,000 over 482,000 times 3,000. You get 218,000. So work in process, we are going to allocate $75. Finished goods, we are going to allocate $218. To cost of goods sold, it's basically what's remaining, basically what's left, and that's $2,707. Okay, now once this journal entry has been recorded, we must remember to post it. So we have adjustments, right? We have an adjustment to work in process, finished goods, and to cost of goods sold. The adjustment to work in process is a credit of $75. The adjustment to finished goods is a credit of $218. And the adjustment to cost of goods sold is $2,707. Once you've done that, we must calculate the adjusted balances. So adjusted ending balance for work in process is 12,000 minus the $75, 11,925. For the finished goods, the adjusted ending balance is 35,000 minus the $218. And for cost of goods sold, the adjusted cost of goods sold is 475,000 less 2,707, 472,293. Okay, so this was the part 3 completed. And then part 4 asks for an income statement for the year. And they're saying, do not prepare a schedule of cost of goods manufactured. Well, as it happens, your exam question will ask for a schedule of cost of goods manufactured. So I am going to prepare one. Okay, I am going to prepare one regardless. So here goes nothing. The company's name was Ravston Company. We are making a schedule of cost of goods manufactured or when for the current year. We don't know which year this is. So for the year ended December 31st, something. All right, we know what the schedule of cost of goods manufactured is supposed to look like. We'll have direct materials. For direct materials, we'll begin with beginning raw materials inventory. We will add raw materials purchased to get raw materials available for use. From raw materials available for use, we're going to subtract ending raw materials inventory to get raw materials used for production. So if we work through those numbers, beginning raw materials inventory was $16,000. Raw materials purchased 200,000. Notice how I'm linking back to the key accounts. So I get raw materials available for use, 216,000. The ending raw materials inventory is $26,000, which means the raw materials that I actually use for production is $190,000. Now, because this number was given, I could have also back calculated the ending raw materials inventory if I wasn't sure. Now, out of this $190,000, indirect materials were 20%, which is $38,000. The rest was direct materials. So you will be required to show this statement on your midterm exam question. Direct labor, 160,000. And then manufacturing overhead, we had a bunch. So just copy these terms and then link back to the numbers. 38,000 was my indirect materials, and I get total manufacturing overhead. $167,000. Add together the direct materials, direct labor, and the total manufacturing overhead. We get total manufacturing costs, 479,000. To this, you want to add the beginning work in process. The beginning work in process was 10,000. And subtract The ending work in process, here you just have to be very careful. You want to use the adjusted number. So the adjusted balance of work in process, 11,925, not the 12,000, be the adjusted amount. So that will give us cost of goods manufactured, 477,075. Okay, once you've made this, then you can go ahead and prepare the income statement. You'll start with sales. Sales were 700,000. Then we want to calculate cost of goods sold. For cost of goods sold, we want to start with beginning finished goods inventory. Add cost of goods manufactured, which will give us cost of goods available for sale. So let's just take a look at that. Beginning finished goods inventory was 30,000. Add cost of goods manufactured, 477,075. Gives us cost of goods available for sale, 507,075. From that, subtract the ending finished goods inventory. Again, just keep in mind that it should be the adjusted number from the T account. The adjusted finished goods inventory is $34,782. So if we subtract $34,782 from 507,075, we get cost of goods sold, 472,293. And this number will be the same as the adjusted cost of goods sold. This kind of tells you that you've been able to link everything back and you've used all the correct numbers in succession. So if on the income statement, your cost of goods sold amount matches the adjusted cost of goods sold from the T account, things are looking good. All right, after that, it's just a matter of going through the motions. You will subtract the cost of goods sold from sales to get 227,707, and that's our gross profit or gross margin as the textbook calls it. Then we must subtract operating expenses. Now, operating expenses were a whole bunch. We had these items. So working with Excel, it's easy. We can just copy what was there. And the dollar amounts can link back. Total operating expenses, 176,000. Subtract the operating expenses from gross margin, we get operating income. Now, sometimes the question will give you a tax rate. For this question, there was no tax rate provided. Say if we were told that the company pays taxes at 15%, suppose. So you will then calculate income tax expense, 15% of the 51,707, that's 7,756. Subtract, and what you get is net income. So let me just make sure I put this comment here. Wasn't given, not given in question. Assumed 15% for demonstration purposes. So we are going to go through actual exam questions in class when we go over chapter 5. I hope that you will take the time to go through this problem's solution. Um, Keep in mind that for your midterm exam, you will not be asked to prepare the journal entries, but you will still need to know what the journal entries are in order to post them into the T account. So think of them as almost like you will have to either be, you will be saying them to yourself and posting them, or if it works better for you this way, you'll record the journal entries, but really there will be no marks for the journal entries. The marks will actually be for posting to the T accounts. And in step 1, we had to calculate the manufacturing overhead rate, the manufacturing overhead applied. These calculations are unavoidable. You will need to do those, as well as step 3, closing of the manufacturing overhead account. Here, the manufacturing overhead was over applied. In the lecture video, we had looked at the example of manufacturing overhead being under applied. And under applied manufacturing overhead, the journal entry is simple. You debit cost of goods sold and credit manufacturing overhead. Only when the manufacturing overhead is over applied that you have to go through this kind of a calculation where you first take the ending balances of work in process and finished goods. And from cost of goods sold, you deduct the beginning work in process and the beginning finished goods inventory. Add these up to get a total amount, prorate the amount to be allocated. So we had to allocate $3,000 in total for ending work in process. Ending work in process, $12,000 out of 482,000. That fraction multiplied by 3,000 gave us the $75. There must be some, few cents and so on, but we are taking the numbers rounded to the nearest dollar. Okay, so nearest dollar, $75 went to work in process, $218 were allocated to finished goods, and $2,707, what remains essentially, is allocated to cost of goods sold. And the effect of this adjusting entry is to reduce the balances of work in process, finished goods, and the cost of goods sold. When making the schedule of cost of goods manufactured, keep in mind that you should subtract the adjusted ending work in process. When making the cost of goods sold section on the income statement, you should use the adjusted ending finished goods inventory. And the end result should be that your cost of goods sold number will match the adjusted cost of goods sold from the T account. Okay, that's it as far as this problem is concerned. I look forward to working on other problems with you folks in class. So for the time being, I am saying goodbye.